This chart shows the S&P 500's growth over the last 18 months. Equities climbed a respectable 18%, but overlaid with gold, the equities trend line looks flat. Gold surged over 60%, shattering the $4,000 and $5,000 barriers in a single run. For centuries, investors have treated gold as a defensive boomer rock. Since the end of the gold standard in 1971, there have only been 3 decades where it actually outperformed stocks and bonds. Most traditional models relied on gold as a simple tool to track inflation. This recent spike has rendered those models obsolete, as prices detached from their historical relationship with consumer costs. This price action signals a break in the mechanics of global finance. To find the source of the anomaly, we have to look at 3 specific drivers currently moving the global economy. Much of this move begins inside institutions like the People's Bank of China. Emerging market central banks are aggressively rotating their reserves away from the US dollar to protect themselves against fiat currency debasement. This strategy accelerated in 2022, when Western nations froze Russia's foreign reserves following the invasion of Ukraine. Other emerging economies realized their dollar holdings were a geopolitical vulnerability. Since then, central bank gold buying has increased 5-fold. This rotation is part of de-dollarization, a policy where nations minimize their reliance on the US dollar for reserves and international trade. By buying gold regardless of the price, countries like China and India have established a massive permanent price floor. This institutional demand is colliding with a rigid physical supply. Global gold mining output is stagnant, growing by only about 1% annually. Central banks created the foundation for this rally, but a structural floor alone cannot explain a 60% surge without a massive injection of momentum. While central banks built the floor, the Federal Reserve's pivot on interest rates provided the momentum. This chart demonstrates opportunity cost, the potential gains an investor gives up when choosing one asset over another. As real interest rates fall on the left, non-yielding assets like gold become attractive to Western investors and ETFs on the right. We see the same pattern on the consumer side. Western buyers have been clearing Costco's inventories of 1-ounce gold bars, while young adults in China are increasingly buying gold beans as a microsaving strategy. This wave of retail and ETF interest added significant volume to the central bank demand. By early 2026, the market was primed for a violent shock. The final catalyst arrived with the direct escalation between Israel, Iran, and regional proxy networks. The conflict centered on the Strait of Hormuz, a maritime passage that handles 21% of all global petroleum transit. This threat created an energy security premium. This premium is the extra value investors assign to an asset to hedge against the possibility of global oil supply disruptions. As the risk of war increased, institutional hedge funds flooded into gold. $5,000 is the mathematical result of these 3 pressures: massive sovereign hoarding, falling interest rates, and war premiums, hitting a market with almost no new physical supply. The question now is whether the market has reached a peak or just a new baseline. We can map the future of gold by looking at 3 specific economic triggers. This chart shows the possible outcomes based on the World Gold Council's matrix. From the $5,000 mark, the market follows 2 distinct paths. The lower trajectory is the bear case, or reflation return. This assumes Middle East tensions find diplomatic resolution and U.S. domestic policies spark high economic growth. Under the Trump administration's economic agenda, a stronger U.S. dollar and higher bond yields would make holding gold much more expensive for investors. In this environment, the geopolitical fear premium would likely collapse, triggering a price correction of 5 to 20%. The upper trajectory is the bull case, known as the doom loop. This occurs if energy flows through the Middle East are severely restricted, causing a spike in global shipping and fuel costs. If the Federal Reserve is forced to cut rates to prevent a recession, gold could surge another 15 to 30%, pushing the price well beyond $6,000. Gold now functions as a real-time barometer for global stability. Its historic rally will likely continue as long as uncertainty remains the world's primary export.